Hi, I'm here with Richard Tambor, the Chief Risk Officer of OneMain Financial. Rich, how are you doing today?
I'm doing great. Thank you, Esther.
Great. So first, I want to start with what you're currently doing for customers affected by the coronavirus outbreak. So what hardship programs are you offering? How long do you plan on offering them? And what plans do you have to help customers avoid defaulting when the programs end?
Sure. So borrower assistance is really an inherent part of what we've been doing for decades as a company. If you think about the customer segment that we serve of non-prime hardworking Americans, uh, those customers, life happens to them, and there are temporary hardships that come in, unexpected expenses. There are customers who just can't make 12 full payments a year. And so we've been offering borrower assistance programs for decades and decades. The primary programs that we offer are paid deferment, which is a reduced payment for 1 month, or temporary modifications, which can be reduced payments and reduced rates for 3 to 6 months. Permanent modifications if there's a permanent issue for a consumer. We've been doing that, as I said, for a very, very long time. That's just part of how we do business. For COVID, we also, back in March and early April, introduced some exceptional programs. We did some relief on credit bureau reporting in terms of new delinquencies. We waived late fees. We introduced some further reduced payment modifications. And what we've done is we've sort of wound those down as things have progressed and we've had better visibility into what's happening. And we're more or less back to our standard set of borrower assistance programs. We continue to work with customers. We continue to try to help them through any temporary hardships with the programs that we run on an always-on basis.
And do you have like any or sort of other plans on assisting customers to avoid them defaulting on their loans?
We're always looking to try to help customers avoid default, whether it's through borrower assistance, making financial literacy and financial education available through our website. We do work with nonprofit consumer credit counseling services and have some relationships with them if consumers need help working through their total debt situation. So those are just part of what we do all the time. We're always trying to help a customer get to a successful outcome, really. And that's not a successful outcome just for us. That's a successful outcome for the consumer.
So now let's talk new applicants looking to take out a loan. How have your eligibility requirements changed with the current economic climate?
Yeah, so back in March, when we were looking into the really unprecedented uncertainty associated with the coronavirus pandemic, we tightened our credit along with virtually every consumer lender in the country. We really looked at, will loans continue to perform if the environment becomes significantly more stressed from a jobs perspective, from a consumer credit repayment perspective. And so really what that does is it makes it, when we look at it, we raise the bar on who's going to be eligible for an unsecured loan, because our unsecured loans have higher loss rates than our secured loans. Our secured loans allow us to offer credit to a much wider group of consumers and be able to support a wider swath of those hardworking Americans that I mentioned earlier. So what we really did back in March and April was tighten our credit box, which made more customers, some customers who maybe 6 months ago we might have made an unsecured offer of credit to, today we're only offering a secured loan to, but we're continuing to service them and provide a product for them. But that's really the biggest change that we made back in March and April. Yeah, still making sure that consumers are still employed, still verifying income, and that they still have the ability to be able to support their current obligations, their current living expenses, as well as any new debt that they may take on, or if they're going to do debt consolidation, making sure that we help put that consumer in a better place through a debt consolidation.
So recently, Fed rates have dropped to record lows. Does OneMain have plans to lower interest rates to remain competitive, and especially if eligibility requirements tighten at any point?
Yeah, that's a great question. So you have to remember our products are fixed payment, fixed term, fully amortizing installment loans, right? So it's not tied to the prime rate. When you take your loan out with us, you're going to know what that payment's going to be every month through the term of the loan, right, based on changes in the interest rates. Rates that we charge are governed by the 44 states that we operate in. So we're licensed in each of the 44 states that we lend in and service customers in. Each state determines the rate construct and the fee constructs, and so we conform with those. And so we're continuing to operate in that construct today.
Um, how has your application process changed in light of the stay-at-home economy? Do you still require applicants to visit a branch in person to complete the process, or is everything online?
So it's interesting. This has been a great learning experience for us. We've been developing omni-channel capabilities. That's been a big focus of the company for the last year or two in terms of our technology investment. We've had the ability to do remote loan closings in the past, and we've done them for, we did do more of those for if you're an existing customer and you were coming back to renew your loan, to take some new money. We would have some number of those customers close remote. That doesn't mean the process is different. They still have to give us income documents. We're still going to go through all of the same underwriting process. We just didn't require them to come into the branch. What we've done since COVID is we've expanded that. We offer it much more widely now to both renewing customers and now more to new customers. So in the past, we might have done a very small number of new customers. We had done some tests. Today, we're doing more new customer remote closings. We've also introduced co-browsing, video, chat, and are making it more available for customers to not have to come into the branch, close the loan, even though all of the same rigor and process goes into the underwriting process, and the budgeting process still goes on. So you're still going to talk with a team member in a branch. We're still going to go through a household budget with you. We're still going to make sure you have ability to pay and you understand all of the terms and conditions of the products that you're going to have. You just may not have to walk into a branch. So it's been a great learning experience for us and really a way to sort of ensure that a lot of the investments we've been making work at a broader scale than perhaps we had seen previously.
That's awesome. And what type of customer would you say that personal loans are best for? And also, who are you not trying to reach?
Who are we not trying to reach? Well, best for, again, our customer segment is, we'll call them non-prime hardworking Americans. So if you just look at the profile of our customers, they really look like Main Street America. They're, average age in their 40s. They have stable employment, stable time at their homes. They have credit files. They've got bank accounts. But at some point in the past, they may have had a credit issue, either because for any number of reasons that people have credit issues. That is our primary market. That's 100 million Americans. It's a big market segment that we serve. We're going to continue to try to service that segment and do everything that we can to provide great products and great experiences for them. We're not a super prime lender. We're not really competing for that 800 FICO customer that a bank is going to lend to. And the other end of the spectrum, we're not a deep subprime lender. So the customers who unfortunately may have to avail themselves of, alternative lenders, payday, pawn, title, et cetera, that's not really our market. We don't compete with those guys. So it's a large market that we serve, and we're going to continue to focus on the market that we serve.
And has the type of non-prime borrower you're targeting changed? Do you think the ideal borrower is attainable right now based on the current market?
Sure. Yes, I think they're attainable. It's still a very large market segment. There are still a very large number of Americans who don't have a lot of liquidity on a day-to-day basis. I think there are Fed surveys that you see numbers of 40% of people can't raise $1,000, or 60% can't raise $1,000, and 40% couldn't raise $400. That hasn't really changed, other than the federal government is sending people checks for $1,000, so now they can. But those folks are out there, and when life happens and they need to replace their hot water heater or do home repairs, or they want to look at debt consolidation, those folks are still out there, and we're going to continue to serve those folks with our products and services. So no, I don't think there's a gap. I think they're still attainable. And if anything, because so many other folks have pulled back, um, either because of their credit appetite or because they can't fund loans right now, we think that there's going to be opportunity for us to actually grow market share. So, we're in a really good place. We've got a very strong company, and we're going to continue to serve those hardworking Americans.
What sets your personal loan? This sounds a little bit like a cliche question, but what sets your personal loans apart from the competition?
Well, first of all, we've been doing this a really long time. The roots of the company go back 100 years. So we've got deep experience servicing this segment of the customer base of the American consumer base. We have lots of expertise in terms of we know how to underwrite it, we know how to service it, and our personal service. The branch model. We talked about remote closings. You're still going to talk to a person. They're still going to walk through what your needs are. They're still going to understand what the best loan product is, or talk about optional products for you. Things like involuntary unemployment insurance. A quarter of our customers have involuntary unemployment insurance that they've purchased for us, which right now seems like a pretty good thing for customers to have, given the environment that we're in. So we have that personal relationship that we establish. We know the communities that we serve. We're in 44 states. We've got 1,500 branches in rural, urban, suburban environments. And so we're really built for a purpose to serve this segment of customers and do it in a personal way, but also bring scale, technology, and service that the size of OneMain allows us to deliver in a really efficient way. So it's, we think we're uniquely positioned to be able to serve these customers.
I'd also like to talk to you a little bit about how you see things changing on like a bigger market level. So
Sure.
where do you see the lending market in the foreseeable future?
Yeah, so there's really two dominant features of what's happening in the lending market right now. One of them we talked about a little bit, which is most lenders have pulled back. Virtually everybody that I know has pulled back credit because of the incredible uncertainty in the environment. You see unemployment rates getting up into double digits, and 40 plus million people have filed for initial claims for unemployment. That's a lot of uncertainty, and lenders are not people who love uncertainty. So we and everybody else have pulled back. So that's feature number one. Feature number two is, and this, I can't say that I fully anticipated this, but consumer demand really pulled back. It pulled back hard in March and April, where I think the shock of the pandemic and the shutdowns of broad swaths of the economy and the uncertainty for consumers and fear caused consumer demand to drop off. So rather than consumers going out and saying, hey, I better get some more cash and take on new loans, consumers went the other way, and they said, I'm just not going to look for credit. You saw that across asset classes. You saw that in credit cards, personal loans, auto loans. And so until there's better clarity with regard to how things are going to evolve, both from a jobs and labor market perspective for consumers, and sort of the economic outlook and the credit outlook for lenders, you're going to be in this state of sort of conservative lending posture from creditors and conservative demand from consumers. The consumers are coming back, but it's still definitely depressed from where.
So with sort of the conservative pullback of sort of demands, is now a good time to take out a personal loan, or would you recommend borrowers hold off if they can?
Every case is unique. Every person is a unique situation. We believe in responsible lending. We believe in being a responsible creditor, and personalized service. And our business model is built around making sure that consumers can support the obligations they have today and will wind up in a good place if they take a loan from us. So, making sure that somebody has the ability to pay, explaining to the customer the terms, making sure they're going to get a good option is what we do. I think everybody should do that. If at the end of the day that's good for a consumer, that's really up to the consumer to judge. If now feels like a good time to do debt consolidation and try to get your put yourself in a place where you can have a clear visibility to paying off your debts through a fixed term loan, then it's a great time to take a loan. If you've got lots of personal uncertainty in terms of your job or your health or anything else, then maybe it's not. But each situation is unique, and that's why we try to work with each person as an individual and figure out what's going to work best for that.
Got it. Thank you so much, Rich. This was a wonderful chat.